This is Kali Persall, editor of Institutional Investing in Infrastructure. And joining me is Brent Burnett, head of infrastructure and real assets at Hamilton Lane. Thank you, Brent, for being here. Can you just start with a brief introduction of yourself to kick off?
Yeah, absolutely. Callie, thanks for having me on here. As you mentioned, I'm Brent Burnett. I'm the head of infrastructure and real assets here at Hamilton Lane. So that means that I oversee all of our investment activities within infrastructure across primary fund commitments that we make, across secondary positions that we buy, and across minority direct and co-investment positions that we're in here at the firm.
So, as you know, historically, infrastructure has been an asset class that is, reserved for large institutional investors. But I have been noticing a trend recently of firms looking to broaden their access to the high net worth and the retail channel. And I understand Hamilton Lane has been doing that, making a point to do that as well. So, what are some of the key factors individual investors should consider when they're investing in infrastructure compared with those large institutional investors?
Yeah, I think the sort of attraction for the private wealth channels and infrastructure are very similar to the institutional investors, and that is, infrastructure as an asset class has delivered median returns that have been consistently better than, say, real estate, for example, which is another alternative. Not quite as good as private equity, but consistently better than some of the other areas of private markets. But it's had a lower dispersion, and so it's an asset class where you've had good total returns, a combination of cash yield and capital appreciation, and a dispersion of returns that looks much more like private credit than other areas of private markets. So a little bit higher median return than some of the other alternatives, but tighter dispersion or lower volatility. So you've had good total returns that have been a mix of income and capital appreciation. You've had good downside protection from those returns. You've had some good positive inflation correlation. So the inflation benefits of infrastructure have been, I think, more acutely appreciated in this type of environment. And then I think you've got some very large macro trends that are driving capital formation that are fundamentally infrastructure enabled trends, right? You think about the rollout of AI, you think about digitization, you think about energy transition, you think about supply chain optimization, and COVID really highlighted these issues of supply chains. All of these themes that are driving a lot of capital formation across public and private markets are fundamentally infrastructure enabled themes. So I think institutions have been scaling up their exposure to infrastructure as an asset class, moving from what was 2, 3, 4% allocations 5 to 10 years ago. Now it's not uncommon to see infrastructure in that 7 to 10% range in their portfolios. I think those same benefits are just now becoming clear to the private wealth channels, but they haven't had access opportunities to private infrastructure like has been afforded to the institutions historically. So, our view is that providing access to those private wealth channels to private infrastructure as an asset class, they will benefit for the same reasons that institutions do. I think the perception is that infrastructure is historically a much less liquid asset class than other areas of private markets. And when we looked back at our data in terms of the sort of regular distribution profile of infrastructure, we found a liquidity profile that was not materially different than other areas of private markets. So, yes, these tend to be longer dated assets, higher capex intensity assets, but it's still an asset that's generated very good distribution. So I think, the hesitation of I'm not going to go into infrastructure because it's a 20-year asset class has been alleviated to some extent by the distribution profile that we've seen from the asset class. Again, it's been very consistent with private equity or other areas of private markets.
So there's been a lot of consideration of how the presidential election would impact infrastructure. How do you think President-elect Donald Trump's economic policies will impact Hamilton Lane's outlook for the asset class, if at all?
Yeah, I think it's a really good question, and I think there's a lot of unknowns, obviously, especially with the Republicans potentially controlling all branches of government. And so I think there was a little bit more, if you ended up with a divided government, I think it was a little bit more predictable as to how that was going to play out. But I think there's a little bit more uncertainty, particularly as it relates to some provisions of the IRA on how a Republican controlled executive branch, House and Senate will look to potentially repeal or change some of those elements of that landmark legislation of the Biden administration. And I think there's a few things that you got to keep in mind on it, especially as it relates to the infrastructure assets. And when I talk about infrastructure assets that were impacted by the IRA, I'm primarily talking about generation assets, uh, onshore wind, potentially offshore wind that I'll talk about, solar, some hydro. So if you think about these assets, I think that there's a few things to keep in mind. Number one, the US has a reasonably weak federal overlay on its power markets. And that's different than other countries in that in the US, states, in terms of determining their renewable energy standards, still have a lot of influence on the types of generation that get built in those states. Each independent system operator in the power market sets their own pricing dynamic, which can incentivize different types of generation within that ISO. So you have that. And so that federal overlay on the US power market, I don't want to say it's nothing. It certainly has a role, but it's much weaker than we think about in other countries where the federal government may have more power to dictate. There's also some very strong market forces that are driving these assets forward, independent of some of those federal programs that impact them. You know, you look at renewable generation today, onshore wind, utility scale solar. You know, these are assets that on an unsubsidized basis are today very cost competitive with traditional forms of generation. So that component of the federal tax or production credit or direct subsidies that drives the underwriting on those assets today is much, much lower than it was 10 years ago. So you've got scale benefits in that sector that make the risk of a change to federal policy on those assets much lower. The other thing, when you look at the renewable generation and what's been driving the power purchase agreement market in that asset class, it's largely been driven by corporates that have been willing to sign PPAs at above market rates in order to secure renewable generation. So, you know, that's kind of a market theme where you've got a counterparty that values that renewable generation for reasons independent from those federal programs. And so I think, you know, with that in mind, you sort of look at the big components of the IRA, and I think the risk to some of those generation assets is pretty low. I think the other big theme, Callie, is that overall power demand in the US is accelerating, and that's different than it's been for the, 20 years prior, where we've been in this environment where the expectation is that overall power demand decreases. So you've got increasing power demand or projections that power demand is going to increase, and that's going to mean you need new generation capacity. Renewables are one of the easiest forms of new generation capacity to build. It's easier to build a utility scale solar asset than it is to build a new natural gas fired generation facility. So I think you're going to see renewables be a larger component because of some of those market forces independent from some of those federal programs. If you look at where the money's gone for the IRA to date, it's overwhelmingly gone to red states in terms of the benefit of the direct federal programs that has been spent on the state. So the largest states that have benefited from this have been Florida, it's been Texas, it's been Nebraska. So there was a reason that legislation was bipartisan. It's because it did benefit constituents in both parties, blue states, red states. So I think the likelihood of major shifts in the big provisions of the IRA are pretty low.